There is no rule or regulation requiring people or organizations or governments to borrow more than they ought to. It's just the way we're wired. If lenders provide cheap money to enable us to live above our means, we will accept it regardless of the repercussions. That's human nature. In this video, we will discuss Ray Dalio's warning of the coming recession that will change a generation. Ray Dalio is an American billionaire, investor, and hedge fund manager. Stay tuned till the end because our last bit of advice could help you. And make sure to subscribe and like the video so that you can learn how to achieve financial freedom. Ray Dalio explains money in terms of transactions. When there is a transaction, it implies that someone is buying something. Usually a person buys a product, service, or financial asset. This transaction may be performed with cash or credit. When you make a purchase using money, the transaction is concluded. You owe nothing. However, when you make a purchase on credit, there is a liability. You still have to pay for the item one day and at a higher cost. You must provide the funds since, on credit, debt is a promise to provide the funds later on. Thus, this is a simple transaction. In other words, they're spending the whole amount of money and credit spent on a thing or service, and then there's the object being purchased, like as a stock, a bond, or a bushel of wheat. Demand is best evaluated by expenditures. Dalio believes that it is a mistake to measure classical economics in terms of the number of products. What is sacrificed in a transaction is cash or credit. As we go through a cycle, we also progress through a credit cycle. Credit may be produced, but not by velocity, contrary to popular belief. Credit can materialize out of thin air. If, for example, you hire someone to paint your home and tell them you'll pay them later, that's credit. It's easy to get into a credit cycle.
If there's not much debt, if you don't have much debt, then you have the ability to borrow money. Let's say you earn $100,000 a year and you don't have any debt, you can then borrow $10,000 a year. You therefore can spend $110,000. Your spending of $110,000 is somebody else's income of $110,000. So it has a positive effect, and you go through a cycle. And through that cycle, you spend $110,000, they earn $110,000, and the cycle becomes self-reinforcing. Through that cycle, debt rises faster than income. Debt rises faster than income. Debt can't rise faster than income forever. So as debt rises faster than income, you have a debt cycle.
Historically, a reduction in interest rates has three favorable impacts. If interest rates are too high, they are lowered. The consequence of lower interest rates is to make it easier to pay debt. It has the effect of making credit purchases more affordable since monthly payments are reduced. It affects the present value of assets. Therefore, if you cut interest rates and have something that is bringing in income, such as a piece of real estate, you have an increase in the present value of that asset, which creates wealth and permits greater borrowing. Therefore, when you reach a point where you can no longer decrease interest rates, let's say when they reach zero, you enter a deleveraging phase. Deleveraging indicates that you can no longer incur debt compared to your income. When debt cannot be increased compared to income, the cycle starts to reverse. According to Ray Dalio,
when you can't raise debt relative to income anymore, the cycle begins to work in reverse. I think that people don't do a very good job of calculating incrementally what the effects are on demand. But let's say you're having debt growth at something like 10% and you go to a 5% debt growth instead. That has a negative effect on growth. It's the marginal change from that level produces a negative effect on growth. Traditionally in deleveragings, that negative effect that happens on, let's say, Europe is a very classic case. The Spanish banking system is a very classic case, the European banking system. As banks leverage up at a certain rate, and they can't leverage up more than that rate, and they lessen the rate at which they're leveraging it up, it has the effect of beginning a deleveraging. Deleveraging means then the income, the spending, all produce sort of a negative cycle. That produces the beginning of a depression.
A depression is the period of deleveraging characterized by austerity and debt restructuring. Since fundamental necessities must be met, if you have an excessive amount of debt to pay, you must take action, and when you do, you have limited options. One method is to combine austerity with debt restructuring. Debt restructuring entails the reduction of debt in some form. As a result of your income, you will owe a debt that you can afford to pay. Reorganizations may occur in one of three ways. You may either genuinely reduce the debt. However, the issue is that one person's obligations are another's assets. Therefore, cutting it into half has a significant negative impact on wealth. Therefore, reorganization becomes problematic. You may reorganize it either by writing it down or in some other fashion. You may stretch the payment or compel a reduction in the interest rate, but in order to service this kind of debt, you must align the payments with the cash flows they generate. This is a painful procedure. Another option is to print more money. If a central bank injects a fixed quantity of money into the economy each year, inflation will be reduced. Consider debt reduction. If something is a debt, you can say, I'll reduce it to a level that is manageable. And let's say you reduce it by 50%. This has a significant negative influence on wealth. If the loan is for 10 years, this may be comparable to 5% every year for 10 years. If you pay this individual 5% every year instead, they will be able to repay the loan. Consequently, the eventual result of all leveraging is the printing of money. It is included in the mix. Now, the most advantageous leveraged things are those that are balanced. Ultimately, you must reduce your debt-to-income ratio. The most frequent error in monetary policy, in Dalio's view, is targeting inflation and growth. And although inflation and growth are essential, it mostly produces debt, and it must focus on debt growth compared to income growth, as well as growth related to sustainability.
The mistake of monetary policy, I think the most common mistake of monetary policy is that it's targeting inflation and growth. And while inflation and growth are important, what it does is it produces debt. And what it has to pay attention to is debt growth relative to income growth relative to sustainability. And so what happens is lots of times you have a lot of debt growth that goes into the purchase of financial assets. And that's a classic bubble.
With investor excitement driving US stock indexes to all-time highs, many fear the formation of a bubble. Obviously, determining whether stock prices will fall is the utmost importance. So in order to test this hypothesis, he has developed a legendary technique. Dalio is arguably one of the foremost authorities on market bubbles. Dalio describes a bubble as a pricing situation that is unsustainable, and his bubble indicator is built on asking essential questions with reference to a variety of statistical data. Performing these computations for individual equities enables him to construct an aggregate market picture and compare it to the past. Borrowing money today creates a moment in the future when you will have to spend less than you earn in order to repay it. This is what causes economic fluctuations and cycles. As more money is allocated to debt payments, consumer spending falls and the economy slows down. As debt is paid off, the situation improves and the reverse occurs. Rinse, wash, and repeat. These cycles are exacerbated when borrowing is used to buy useless expenditures. This is the result of excessive credit card spending without sufficient cash or savings to pay down the bill. A similar situation occurs in real estate when individuals purchase too much property without sufficient finances to cover the higher loan expenses. Deferred gratification is not enjoyable, however, spending now is. However, every purchase you make on credit today reduces your future spending power. This demands a fine balance between appreciating the current moment and planning for the future. In the future, you will be responsible for all of the expenses you incur today. Just because the economy is designed to fail about every decade due to human nature does not imply that you must also experience a personal financial crisis cycle. Managing your debt and investing for the future might be beneficial. In uncertain times, your emergency funds must be backed by a secure, diversified portfolio, according to Dalio. He encourages individuals who favor Bitcoin or gold to avoid making an all or nothing choice. If you like this video, be sure to hit that like button and subscribe to find out more ways you can become financially independent.